Hi everyone, welcome to the session. In this video, I am going to discuss about recognition and measurement of goodwill. Prior to that, let's understand the meaning of goodwill. So, what is goodwill? Basically, goodwill represents the intangible element of a business that are acquired by the purchaser. So here the business means a subsidiary company. The purchaser means the parent company. So when a parent company acquires a subsidiary company, the goodwill arises. So when a parent acquires a subsidiary, the goodwill arises. This goodwill includes reputation of the subsidiary. What does it mean? Which means, let's say if the subsidiary company is a well-reputed company, for reputation, the acquiring or the parent company will have to pay a premium price over and above the value of the company. So here the value means the net assets of the company. So reputation constitutes a goodwill. The second one is the customer loyalty. So apart from that, customer loyalty towards the company will increase the value of the company. Further, if a company has a good customer base, that will also lead to a higher price. So these are the basic elements of goodwill. So how do you calculate goodwill? So let's move on to calculation of goodwill. So how do you calculate goodwill? So basically, goodwill is the excess of the fair value of consideration transferred plus the non-controlling interest over the fair value of identifiable net assets acquired. So what does it mean? So what does this mean? So let's assume a company called P, a company P has acquired 100% shares of S company. So at the time of acquisition, the S company, the value of the S company or the net assets at the time of acquisition was 230 million. To acquire this S company, the P has paid 250 million. So this is the purchase consideration of 250 million paid by P to acquire S company. So S company's value is 230 million. So what is this difference? The P has paid 250 to acquire 230 million. So what is this difference? So this is the excess amount over the fair value of identifiable net assets. So which is known as goodwill. So $20 million is known as a goodwill. Here, since it is 100% acquisition, there is no non-controlling interest. So otherwise, the non-controlling interest has to be added along with the purchase consideration, which is the 250 million. So you need to add back to calculate the goodwill. The resulting goodwill may be positive, or in some cases it will be negative. So I will discuss how to deal with this positive and negative goodwill in my future videos. Now, there are some basic definitions we should know in understanding the consolidation process. So first one is the parent. So who is a parent company? So parent is an entity that controls one or more subsidiaries, or else we can call it the acquirer. Is the acquirer is the entity that obtains control of the acquiree. So this is the parent company. Then subsidiary company or the acquiree is an entity that is controlled by another entity. So that is the meaning of a subsidiary company. Or is the business or businesses that the acquirer obtains control. If the acquirer obtains control over subsidiary, so that company is known as a subsidiary company. Then what about NCI or the non-controlling interest. So non-controlling interest means is the equity in a subsidiary not attributable directly or indirectly to a parent company. So in other words, we can say the share of equity owned by another entity in a subsidiary. For example, we can say a parent has acquired 75% of subsidiary company and the remaining 25% is acquired by the non-controlling interest. So this percentage acquisition in subsidiary company is known as the non-controlling interest. So when you prepare consolidated financial statement, so consolidated financial statements are also known as group financial statement. Group financial statements. So these are the financial statements of a group in which the assets, liabilities, equity, income, expenses, and cash flows of the parent and its subsidiaries are presented as one single economic entity. So we need to consolidate, we need to combine all these assets, liabilities, income, and expenses along with the subsidiary company. So consolidation process involves adding together the assets, liabilities, income and expenses of parent and subsidiaries on line by line basis before making consolidation adjustments. So this is what we need to do. So what we need to do is we need to take the parent company financials, the assets, liabilities, equities, all the items should be combined with the subsidiary company assets and liabilities. Then we need to make certain adjustments to eliminate intercompany transactions and other transactions as well. Then we need to prepare the consolidated financial statement. So these are known as group financial statement. So one such adjustment is the goodwill on acquisition. As you can see, so goodwill adjustment has been done in order to arrive at the group financial figures. As you can see, the goodwill on acquisition has been adjusted in this column to arrive at the group financial statement figures. So one such adjustment is the goodwill adjustment. So in this session, what I'm going to do is I'm going to discuss about how to account for the goodwill. So in order to calculate goodwill, what you should do is you should compare the purchase consideration. So what you should do is you should compare the purchase consideration paid to the acquiree with the net assets of the acquiring company. Acquiree. Net assets of the acquiree at the acquisition date. So if it is 100% acquisition, the calculation is very easy. If not, if the acquisition is less than 100%, the calculation is little bit complicated because there is non-controlling interest. So non-controlling interest has to be identified and it has to be adjusted when calculating the goodwill. So this is the first adjustment that you need to do when preparing the consolidated financial statements. So in this video, what I'm going to do is I'm going to calculate by taking different examples. So I will show you how to calculate the goodwill. Let's move on to the first question. P company acquired 100% of S company at a cost of 90 million. On the acquisition date, the fair value of the identifiable net assets of S company was 85 million. So calculate the goodwill arising on acquisition. As I told you in my previous video, in my previous session, if there is 100% acquisition, the calculation of goodwill is very easy. Now what you need to do? So you have to compare, the consideration, the purchase consideration plus the consideration transferred So you need to compare the consideration transferred plus the non-controlling interest with the identifiable net assets. So with the identifiable net assets. So when you take the difference, you can identify the goodwill. So this is the goodwill. So if you deduct the consideration transferred plus the non-controlling interest against the identifiable net assets at the time of the acquisition of the acquiree, so you can identify the goodwill. So how much is the consideration transferred? So 90 million. So 90 million is the amount paid to acquire the S company by P company. Where is the non-controlling interest? There is no non-controlling interest because 100% acquisition. How much is the identifiable net assets? So identifiable net assets was 85 million. So this was the value of the S company at the time of acquisition. So therefore, the goodwill is 5 million. So basically, to calculate the goodwill, what you need to do? You need to take the fair value of the consideration transferred, then you need to add the non-controlling interest. So that has to be added back. From that, you need to deduct the fair value of identifiable assets acquired and liabilities assumed. So thereby you can arrive at the goodwill. So this is the formula to identify the goodwill. So let's move on to the second question. AG company acquired 100% of the shares in SAM company on 1st January 2018. The agreed consideration was, so AG has agreed to pay SAM company, which is 100% acquisition, there is no non-controlling interest, 230 million cash payment immediately. So this is the immediate payment. Then 100 million cash payment on 1st January 2019, assuming that SAM achieves a specified level of revenue growth. So AG has agreed to pay 100 million after 1 year of the immediate cash payment of 230 million on the condition that SAM should achieve a specified level of revenue growth. Okay, so this 100 million is not immediate after 1 year's time. The fair value of the identifiable net assets of SAM company, the company's net assets, the SAM subsidiary company's net assets on the acquisition date was 240 million. The fair value of the contingent consideration was deemed to be 70 million. So calculate the goodwill on arising on the acquisition. So what you should do, you have to identify the cash consideration. How much is the cash consideration paid immediately, which was 230 million. Then the fair value of the contingent payment. Fair value of the contingent consideration was 70 million. So you can see which is 70 million. Even though you have to pay 100 million after 1 year's time, you need to calculate the goodwill at present. So when you calculate at present, you should identify the fair value of the consideration. So which is already calculated as 70 million. Otherwise, if you are given a discounting factor, you can discount it and you can take the present value of the amount to be paid after 1 year's time. Then from this total, which is 300, you need to deduct less the fair value of the identifiable net assets. How much is that? The fair value of the identifiable net assets was 240 million. So therefore, the goodwill will be how much? Goodwill will be 60 million. So this is the answer for the part 2. So let's move on to the question number 3. AG Company acquired 80% of Sun Company in 2017 at a cost of 515 million. So the purchase consideration was 550 million was paid to acquire 80% of Sun. The fair value of the identifiable net asset of Sun Company on this date was 550 million. And the fair value of NCI, the non-controlling interest, was 120 million. If the NCI is measured as a proportion of net assets, calculate the goodwill arising on acquisition. Okay, so now you are required to calculate the goodwill based on the proportion of net assets for non-controlling interest. However, you are given the fair value of NCI as well, which is 120 million. So let's calculate, first of all, as a proportion of net asset. So goodwill as a proportion of net assets. Okay. So what is the consideration paid? Consideration transferred, we can say how much? 515 million. So we need to add back the non-controlling interest. How much is that? So it has to be, it has to be based on the proportion of net assets. So net assets at the time of acquisition was 550 million. So of this 550, 20 million belongs to the non-controlling interest. So that will be 110 million. From this, you deduct the fair value of identifiable net assets. So which will be 550. So thereby the goodwill will be 75 million. So this is the goodwill. So basically this is based on the net assets. Supposing if you calculate based on the fair value, so based on fair value, how you will calculate? So you take the consideration transferred, there's no change, 515, then the NCI. So NCI should be the fair value. How much is the fair value of NCI, non-controlling interest? 120 million. So instead of the net assets, so you can take the fair value. Then fair value of identifiable net assets will be 550. So thereby you can say the goodwill as 85 million. So it depends on the examiner. If you are asked to calculate the goodwill based on the net assets, so you can apply this method. Otherwise, you have to use the fair value. Is that clear? Okay, so this is the answer for the question number 3. Now let's move on to the question number 4. Question number 4, AG Company acquired 90% of S-Light Company in 2019 at a cost of 360 million. So this was the purchase consideration transferred to acquire S-Light. The carrying amount of the net assets, okay, so identifiable net assets of S-Light Company on the acquisition date was 325 million. However, the fair value of the identifiable assets of the company was 350 million. The fair value, this is the carrying value. So this was the carrying value, 325. However, this was the fair value for the following reasons. So 325 has increased to 350 due to the following reasons. What are the reasons? S-Light had developed a brand name with a fair value of 15 million, but this was not recognized in its own financial investments. So basically, so 325 has to be increased by how much? 15 million. This was not identified in the financial statement because of the brand name. And the second reason, the land with carrying amount of 65 million had a fair value of 10 million in excess of this. So basically, the carrying value was 65 million and the fair value is in excess of 10 million. So which means the 75 million is this fair value. So therefore, the fair value increase is 10 million for the land. So this is also not accounted in the carrying value of 325. So when you add 325 plus 15 plus 10, so that will be 350 is the fair value. Okay, so that's very simple. Now let's calculate the consideration transferred. How much transferred? 360 million was transferred. Then the non-controlling interest of 10%, we need to calculate on the fair value of the identifiable net assets. On that 10% will be how much? 35 million. Then the carrying amount, okay, so you need to deduct the identifiable net assets, of which we had the carrying value. So this is the fair value of the identifiable net assets. So we had a carrying value of 325. So that was increased by the brand name. The brand name increase was 15 million and the fair value adjustment on land, fair value adjustment, okay, on land was 10 million. So thereby the total fair value will be, fair value of the net assets will be 350. So 360 plus 35, 395 minus 350 will be 45. So that will be 45. That will be the goodwill. So this is the answer for the question number 4. Okay, now let's move on to the question number 5. It's a bit lengthy question. Question number 5. P company acquired 75% of S company. S company is 80 million shares on 1st January 2016. So P has acquired 75% of 80 million shares. So it paid 25 per share, agreed to pay a further 1,070,000 on 1st January 2017. The following details are relevant to the acquisition date. Okay, so what has happened? P company has paid, P company has acquired 75% of 80 million shares, of which they paid 25 per share. Plus, they have agreed to pay another 1,070,000 after 1 year's time. So these are the purchase consideration. So the fair value of the non-controlling interest was 255. So non-controlling interest fair value amount was given 250 million. The carrying amount of the net assets of S company was 2,350,000. So carrying amount of the net asset of the subsidiary company was 2,350,000. The fair value of S company's head office was determined to exceed its carrying amount by 50 million. Okay, so though you are given the carrying amount of the net assets, the carrying amount of the net assets as 2,350,000, however, the fair value of the head office was going to exceed the carrying amount by 50 million. So you are given the carrying amount 2,350,000. However, this amount will increase by the increase in the fair value of the head office by 50 million. S company had not recognized a publishing title in its own statement of financial position. This was deemed to have a fair value of 10 million. Okay, so this carrying value of the net asset doesn't, the carrying value of the net asset 2.350 million doesn't include this 10 million of the publishing title, the value of the publishing title. So therefore, when you calculate the fair value of the identifiable net assets, you need to add back. S company had disclosed a contingent liability resulting from a legal case. This was not recognized as a provision by S as the probability of the payment was estimated to be less than 50%. So this carrying value doesn't carry this contingent liability. The maximum exposure was 20 million. The fair value of the contingent liability at the acquisition date was estimated to be 15 million. So this contingent liability was not accounted here, so therefore this has to be accounted. However, you have to account for the fair value of the liability, not the actual exposure of 20 million. Okay, the parent company's cost of capital is 7%. Okay, now let's calculate the goodwill. First of all, consideration transferred. How much was the consideration transferred? How much? There are two components. First one is the immediate payment, which is 80 million times 75% times 25 per share. So which will be 1.5 million. Then there is a deferred consideration of 1,070,000. So since we have to take the fair value, you need to calculate the present value of the payment, because they agree to pay this after 1 year's time. Okay, so what you can do is, so 1,070,000, if you take the discounting factor, because you are given the cost of capital as 7%, so 1.07%, so you can identify the discounting factor. So that will be how much? So that will be 1 million. Then you add back the non-controlling interest. Non-controlling interest, here you can't take the fair value of the identifiable net assets, because straight away you are given the fair value of the non-controlling interest as 250 million. So you need to take the fair value of the non-controlling interest 250 million. So from this total, so you need to deduct the fair value of identifiable net assets. So you know the carrying value. The carrying value was 2,350,000. So 2,350,000. So this will increase by the fair value adjustment for the head office, because the carrying value is going to exceed by 50 million. So we can say the fair value adjustment for head office 50 million. Then there is another adjustment for the publishing title, fair value adjustment, that is the intangible assets. Their fair value, intangible, how much is that? It's going to be 10 million. It's going to be 10 million. Then there was a contingent liability, the contingent liability of 50 million, the fair value adjustment for the contingent liability, that is a legal case, which is 15 million. It's a liability, therefore you need to deduct from this total. So once you take the total, that will be, so this will be 2,395. So thereby the goodwill will be 355. So this is the goodwill calculation for the question number 5. Hi everyone, welcome to the session. In this session, I am going to discuss about how to prepare a consolidated financial position. So in this regard, I have selected one question. So let's go through the question first, then we'll move on to discuss how to prepare a consolidated financial position. So let's go through the question. Paul acquired 75% of the 50,000 shares in SAM on 1st January 2017. So Paul has acquired 75% of the shares of SAM company. The market price of SAM's shares just before the acquisition was $1,300 per share. Paul measures the non-controlling interest at fair value, and the market price is the best indicator of this. Now, at the time of acquisition, the SAM's company's shares are 1,300 per share. So we need to calculate the non-controlling interest based on the fair value, not based on the current assets, not based on the net current assets, not based on the net assets at the time of acquisition. So it has to be based on the fair value. Okay. So statement of financial position of Paul and Sam at 1st January 2017 were as follows. So you are given the Paul company financial position as well as Sam company financial position. So what is required is prepare the consolidated schedule of the Paul group at the acquisition date. So what is the acquisition date? So what is the acquisition date? So acquisition date is on 1st January 2017. So you need to prepare the consolidated schedule of Paul group. Okay. So Paul is the parent company, Sam is the subsidiary company. So Paul has acquired 75% of Sam company. So on 1st January 2017. So this is the acquisition date. Okay. So on this date, the share price was 1,300 per share. So how many shares were there? 50,000 shares. Okay. And 25% of the shares belongs to the non-controlling interest. Okay. So at the time of acquisition, we need to identify the net assets, identifiable net assets at the time of acquisition. So what will be the identifiable net assets? So which will be share capital 50,000 and retained earnings will be 25,000. To acquire these net assets, the Paul has invested 70,000. Paul has invested 70,000. Now, based on this, you need to prepare the consolidated schedule at the acquisition date. Okay. So you are not given any post acquisition transactions. Okay. So therefore, this is very simple calculation. So if the post acquisition information are given, then we need to incorporate the post acquisition profit as well. So in this question, we don't need to deal with the post profits. So straight away we need to prepare the consolidated schedule. Now, in order to prepare the consolidated schedule, so what we need to do is we need to combine the parent and the subsidiary company, the financial position, and we need to take the combined financial position. Then from the combined financial position, we need to make certain adjustments. Okay. So we need to make certain adjustments to identify the consolidated financial position. Consolidated financial position. Okay. So now when you prepare the consolidated financial position, there are certain items which are under financial position of parent company will be removed, as well as certain items in the subsidiary companies will be eliminated when you prepare the group financial position, because it will not form part of the group. Certain transactions belongs to parent and certain transaction belongs to subsidiary companies will not form part of the group. So therefore we need to make certain adjustments to remove those transactions. So let's move on to the calculation part. So we need to prepare the consolidated schedule as at the acquisition date. Now I have taken the Paul and Sam company financial positions, okay, and I have already taken the combined financial position. It's a line by line addition. Let's take the first item in the financial position, which is the property, plant and equipment. So 60,000 plus 50,000 will be 110,000. Then shares in S, 70,000. So this is the investment made by Paul company in Sam company to acquire the net assets of subsidiary company. So 70,000. The total non-current assets will be 180. So 130 plus 50. Current assets 52 plus 70, 35 will be 87,000. So total will be 267,000. Then stated capital or the share capital of the parent is 100 and Sam company 50, 150. Retained earnings 70 plus 25, 95,000. Then the current liability is 12,000 plus 10,000 will be 22,000. So the share capital plus retained earnings plus the current liability will be 267,000. So this is the combined financial position. So as you can see, when you prepare the combined financial position, I have taken one line for goodwill as well as non-controlling interest. Okay. So when you prepare the consolidated financial position, first of all, what you need to do is you need to compare the investment made by parent company along with the net assets of the subsidiary company to identify the goodwill. Okay. So therefore, let's take the adjustment column. So this is the adjustment column. So I'll take the adjustment column for the acquisition journal. So first of all, what you need to do is you need to remove the investment. You need to remove the investment from the consolidated financial position. So it should not be there in the consolidated financial position. So therefore we need to remove that. Okay. So by removing this, we have to compare this with the net assets. So what will be the net assets? So net assets will be 50 plus 25. So you need to compare with this to identify the goodwill. So let's calculate the goodwill part of it. So what will be the goodwill? So goodwill will be the purchase consideration. So how much is the consideration transferred or the investment made? Which is 70,000. Which is 70,000. So to this 70,000, you need to add the non-controlling interest at fair value. Okay. So at fair value, you need to add this non-controlling interest. How much is that? So you are given the market price of SAM shares just before the acquisition as 1,300 per share. Okay. So let's take 1,300 per share. So 1,300 per share. So that will be how much? 16,250. Okay. So then you need to remove the net assets, identifiable net assets at the time of acquisition, which will be 75,000. So then the goodwill has to be 11,250. So your goodwill is 11,250. Okay. So that goodwill has to be shown as the consolidated financial position goodwill. Okay. So goodwill in consolidation has to be shown in the consolidated financial position. So therefore you need to show this under adjustment column 11,250. Then since we are removing the net assets, we are comparing with the the amount invested. So we need to remove it from the net assets of SAM company. So 50,000 has to be removed, 25,000 also has to be removed. So therefore, when you take the consolidated financial position, the investment made by parent company will not be part of the consolidated financial position because the group does not have any investment. It will not form part of the consolidated financial position or the group financial position. And in the meantime, the stated capital or the share capital, okay, the stated capital will be the capital of the parent company in the consolidated financial position. So in the consolidated financial position, what we have to show as stated capital will be the parent company share capital, simply because the owner of the group is the parent company or the pole, not the SAM, not the subsidiary company. So therefore, the stated capital or the share capital has to be part of the consolidated financial position, which is the parent company. The subsidiary company will not form part of the group. As well as the retained earnings also, we need to take the parent company. We need to take the parent company, not the subsidiary company, because it will not form part of the group financial position. Simply because these net assets at the time of acquisition will be compared, this will be compared with our investment made by the parent company. Okay, so we have removed this. Apart from that, we have to recognize the goodwill, and also we need to recognize the non-controlling interest. Okay, the non-controlling interest balance will appear in the equity and reserves section of the consolidated financial position, because this will reflect the fact that although the parent company controls the net assets of the subsidiary company, the non-controlling interest legally owns a proportion. Okay, so non-controlling interest legally owns a proportion of SAM company. So therefore, the non-controlling interest will form part of the group financial position. So we calculated that as 11,000. How much non-controlling interest? 16,250. So we have to show that 16,250 as non-controlling interest. So this will be the non-controlling interest column. Then this will be the consolidated financial position column. So now let's take the remaining balances. The property, plant and equipment, so line by line we are adding. So 110,000 will remain the same. There is no adjustments. So later on there will be, later on I will discuss the adjustments relating to the consolidated financial position with regard to other items in the financial position. So since there is no adjustments required for this, so let's take the full amount 110,000. So investment we are eliminating from the total column with the adjustment column. So there is no balance here. It will be 0. Then the goodwill has to be recorded. Goodwill will be the part of the financial position. So therefore the total non-current assets will be 121,250. Then the current assets also, there are no adjustments required. Straight away we can take 87,000. Then the total will be 208,250. Okay, so this will be the total current total assets. Now the equity, the share capital will be only the parent company, because group is owned by the parent company. So therefore we have to take 100,000. So 50,000 we have eliminated. So retained earnings also will be the parent company retained earnings, which is 70,000. So 25,000 of subsidiary company we have removed to calculate the goodwill. Then the non-controlling interest we calculated. So this has to be part of our consolidated financial position, simply because they own part of the shares in SAM company. So therefore the group has to be, therefore the non-controlling has to be shown in the consolidated financial position. Then the total will be So 186,250. The current liability, there are no adjustments required. So therefore you can take straight away 22,000. So when you add up, the total will be 208,250. So this will be the consolidated financial position as at the acquisition date. So this is the answer for this particular question. Hi everyone, welcome to the session. In this session I'm going to continue my discussion on consolidation accounting. So in this particular session I'm going to continue my discussion on non-controlling interest, how to calculate non-controlling interest when there is pre and post acquisition profits. So in this regard I have taken an example. So let's go through the example, then we'll come back to the solution. Peter Company acquired 90% of the 100 million share capital of Silva Company on 1st January 2016, when the retained earnings of Silva Company were 300 million and the revaluation surplus was 80 million. The fair value of the NCI at this date was 50 million. Okay, so you are given the NCI, you are given the fair value of the NCI as 50 million. In the year ended 31st December 2016, Silva reported profits of 60 million and a revaluation deficit of 10 million. So please remember, these are subsequent to the acquisition. So these are post-acquisition profit. What is the carrying amount of the NCI in Silva at 31st December 2016 if the NCI is measured as a proportion of net assets? And the second one is if it is measured at fair value. Okay, the question is very clear. Now you are given the pre and post acquisition profits and the NCI, the fair value of the NCI is also given. Okay, and you are required to calculate the NCI as a proportion of, if it is measured as a proportion of net assets, as well as if it is measured at fair value. So you are required to calculate NCI at the reporting date. Okay. Now let's take the let's analyze this question. Peter acquired Silva 90% of the share capital. Okay. This was acquired on 1st January 2016. The acquisition date will be 1st January 2016. At the time of acquisition, the share capital was 100 million and the retained earnings were 300 million and the revaluation surplus 80 million. So 300 million and the revaluation surplus or revaluation reserve 80 million. The total net assets at the time of acquisition were 480 million. So this was at acquisition. Subsequent to the acquisition, the company profit has further increased by 60 million. Okay, so this increased by 60 million and the revaluation reserve reduced by 10 million. There was a revaluation deficit. So therefore this reduced by 10 million. So therefore, if you take the snapshot of the financial position at the time of, at the reporting date, which is 31st December 2016. So what will be the financial position? So let's take it. So 31st December 2014, this is the financial position. Share capital remains the same, 100 million. However, the retained earnings increased by 60 million. So therefore, the total net retained earnings will be 360 million. However, the revaluation reserve reduced by 10 million. There was a revaluation deficit. So therefore, it will be 70 million. So therefore, the net assets will be 530 million at the reporting date, which is 31st December 2014. So basically, these profits are post profit and this is prior to acquisition, pre. Okay. Now how do you calculate NCI? In my previous video I discussed when NCI is calculated as a proportion of net assets. There are two ways where you can apply, but the second method will be the easiest method where you can save time. Okay, so this is what I am going to apply in this calculation. So I am not going to show you the first method. So if you want to watch that method, so what I am going to do is I am just going to put the link above. So what you can do is you please go and watch that video. Okay, so the NCI on 31st December 2014 based on net assets. So how do you calculate this? How do you calculate? So if it is based on net assets, forget about the pre and post. Take the net assets at the reporting date straight away, which is 530 million. So net assets on 31st December 2014 was 530 million. On that 10% will be how much? 53 million. So this will be the NCI at the reporting date based on net assets. Okay. The second part, if NCI is measured at fair value, if the NCI is measured at fair value, you just can't straight away apply 10% of the net assets. So therefore, we need to apply the first method. So how do you calculate that? First of all, you need to take, net assets, we'll take non-controlling interest at the reporting date. Okay, so here we need to take the fair value. At the time of acquisition, the NCI, this is NCI, NCI was 53 million. The fair value of, it was 50 million, So this is NCI 10%. At the time of acquisition, the fair value of NCI was 50 million. Okay, so we need to take the fair value of NCI at acquisition. How much? 50 million. To this, we need to make an adjustment to the subsequent profits. Okay, so we have taken the fair value of NCI at acquisition 50 million. To this, we need to take subsequent, which means the post profits. So when you take the financial position as at 31st December 2014, as you can see, the return earnings increased by 60 million. So therefore, the portion of this 60 million should go to NCI, which is 10%. Okay, so 10% of 60 million. So this is the retained profit. So 60 million times 10 will be 6 million. Apart from that, there is revaluation reserve, which decreased by 10 million due to revaluation deficit. So therefore, this 10 million has to be adjusted here. So revaluation deficit, which is 10 million minus 10% on that will be 1 million minus. So therefore, 56 plus 1 minus will be 55 million. So 55 million will be the non-controlling interest based on the fair value. Okay, so this is the answer for the part 2. So basically, this is how you calculate the non-controlling interest when pre and post acquisitions profits are given. If the NCI is calculated based on as a proportion of net assets, so what you can do is straight away, to save time, you can apply the percentage of NCI on the net assets at the reporting date. Otherwise, if it is based on the fair value, what you can do is take the fair value, make adjustments to the subsequent profits. Okay, so here in this case it was 50 million, and subsequently the company made a profit of 60 million, and there was a revaluation deficit of 10 million. So those adjustments, once you made it, okay, so you can arrive at the non-controlling interest at the reporting date. Hi everyone, welcome to the session. In this session I'm going to continue my discussion on consolidation accounting. So in this particular session I'm going to discuss about how to calculate non-controlling interest when there is pre and post acquisition profits. Okay, so when you are given pre and post acquisition profit, how to calculate non-controlling interest. This is what I am going to discuss. So there are two ways where you can calculate non-controlling interest when there is pre and post acquisition profit. The second method that I am going to discuss will be the easiest method to calculate the non-controlling interest. So it won't take much time, so you can save time in the exam. Okay, so if you continue to watch till the end, I am going to show you the difference between the first and the second method. Okay, so let's move on to the question, then we'll try to I will come back to the solution. So let's go through the question. P company acquired 75% of S company on 1st June 2014 at a cost of $325 million. At that date, S company had a share capital of $100 million and retained earnings of $200 million. The NCI is measured as a proportion of the net assets of the subsidiary. Since acquisition, S company has made 100 million profits and recorded no other comprehensive income as on 31st December 2014. So you are required to calculate the non-controlling interest at reporting date. So what is required? You need to calculate the non-controlling interest at the reporting date. So the company was acquired on 1st June 2014. 1st June 2014 the company was acquired, but you are required to calculate NCI at the reporting date, which is the 31st December 2014. Okay, so let's take this example. P company acquired S company, 75% of S company. The investment was 325 million, and this company was acquired on 1st June 2014. So this is the acquisition date. Okay, so at the time of acquisition they had a share capital of 100 million and the retained earnings of 200 million. So therefore the total net assets at the time of acquisition was 300 million. So after the acquisition, the company, S company, has made a profit of 100 million. S company made a profit of 100 million. So this will be after the acquisition. This is the post acquisition profit. This is prior to the acquisition. This is pre. Okay. Now if you take the snapshot of the financial position at the reporting date, which is 31st December 2014. So what will be the net assets? So let's take 31st December 2014. So this is the reporting date. So they have the share capital, it remains the same. The share capital will be 100 million. Then the retained earnings, the pre-return earnings was 200 million, and subsequent to acquisition, subsequently the company made a profit of 100 million. So therefore 200 plus 100 million will be 300 million. So therefore the net assets will be at the reporting date, which is 31st December 2014, will be 400 million. Now you need to calculate the non-controlling interest. So now you need to calculate the non-controlling interest. So non-controlling interest will be 25%. So 75% is acquired by the parent company. So now as I told you, there are two methods where you can calculate. The first method is where you calculate the non-controlling interest at the time of acquisition. Okay, so at acquisition, what was the net assets? On that you take the non-controlling interest percentage. So thereby you can identify the non-controlling interest at acquisition. Then to that you need to add whatever the post-acquisition profit. On that you take the 25%. Then you add that profit to the non-controlling interest at the time of acquisition. thereby you can arrive at non-controlling interest at the time of reporting. So let's calculate this. So first of all, the first method, non-controlling interest at the time of acquisition will be, you take the net assets, how much? 300 million times 25%. So this will be 75 million. So the NCI at acquisition will be 75 million. In fact, this I already discussed under my previous discussion on Goodwill on consolidation. So I have given the link, so you can watch that video. So this is how you calculate the net assets, non-controlling interest at acquisition. To this you need to add whatever the post profit earned after the acquisition. So post profit will be 100 million. So they had a return earning of 200 million, subsequently they earn 100 million. So on that 100 million, we need to take 25%, which is the non-controlling interest percentage. So thereby it will be 100 million. So this is the non-controlling interest at the reporting date. Which is 31st December 2014. Okay, so this is how you calculate. So this is the first method where you calculate the NCI. So what is the second method? The second method is very easy method, where you take the net assets at the reporting date. On the total net asset, straight away you apply the percentage. Okay, so the net assets at the reporting date 400 million, on that 25% will be 100 million. Okay, so this is the second method where you can calculate the NCI. So this is the first method and this is the second method. Okay, now the problem here is, the issue here is, you can calculate based on the second method, where you are asked to calculate the non-controlling interest as a proportion of the net assets. Okay, so if you are asked to calculate the NCI as a proportion of the net assets, then straight away you can apply the percentage on the net assets at the reporting date. So otherwise, if the NCI is calculated based on the fair value, you can't apply this method. Is that clear? So anyway, I am going to discuss the question relating to fair value as well. Hi everyone, welcome to the session. In this session, I am going to continue my discussion on consolidation accounting. So in this session, I am going to discuss about intercompany transaction. So what are intercompany transaction and how do you account for intercompany transaction? So this is what I am going to focus on this video. So I will be discussing intercompany transaction. So when you take intercompany transaction, mainly the intercompany transaction consists of intercompany sales, intercompany lendings, intercompany transfers of property, plant and equipment. So what are intercompany transactions? So this is mainly consists of intercompany sales, intercompany lendings and intercompany transfers of property, plant and equipment, PPE. So these are the areas that will be tested in your exam. So first and foremost, let me discuss about intercompany sales. So in order to discuss this, let me take an illustration. So let's assume P company has sold $100 worth of goods to S company. Okay, so let's assume there is no profit. Okay, so without profit, let's try to understand how to account for this intercompany transaction. So P has sold $100 worth of goods to S company. So as far as P is concerned, okay, so P will record this particular transaction in their books of account as sales. Okay, so they will treat the P company will treat this particular transaction as a sale. So as a result of that, the P company will record this particular transaction as account receivable debit $100 and sales account credit $100. Okay, so if you take the standalone separate financial statement for P company will treat this as a sale. So as a result of that, if it's a credit sale, they will debit the accounts receivable account and sales account will be credited. So when it comes to S company, so as far as S company is concerned, so S company will treat this particular transaction as purchases. So as far as S company is concerned, this is a purchase. So when there is a purchase, how they will record this particular transaction? So if you take the separate financial statement, so that will be purchases account debit 100 and accounts payable account will be credited 100. So this is how this particular transaction will be recorded in their separate financial statements. Okay, so when it comes to the group, so this is the group. So what is the impact on the group financial statement and how do you account for this particular transaction? So when it comes to the group is treated as a separate single entity, economic entity. So as a result of that, the transactions within the group has to be eliminated. So whatever the transaction they have done with the outside party has to be recorded in the group. So within the group has to be eliminated because they have not made. So as far as the group is concerned, group has made neither sale nor purchases. So therefore, these particular transactions, basically we are discussing about consolidated financial position, how to prepare a consolidated financial position. So when you take the consolidated financial position, when you prepare the consolidated financial position, you need to follow the line by line method. So when you consolidate the accounts receivable, all the current assets and current liabilities will have to be added together. Okay, so when it comes to the group, since these are intercompany transactions, these transactions will not be appear in the group financial position. So this has to be eliminated. So basically, when you take the consolidation schedule, this I have already discussed how to prepare the consolidation schedule when you prepare the consolidated financial position. So if you want to watch that particular video, I have given the link. So what you can do is please go and watch for your understanding. So when you prepare the consolidated financial position, there will be an adjustment column. So in the adjustment column, you need to eliminate this particular transaction. So accounts receivable has to be eliminated. So therefore, when you take the group, there won't be any accounts receivable balances in the group. And when you take the accounts payable, this has to be eliminated. So there won't be any accounts payable due to parent company. So this has to be eliminated here. So as far as the group is concerned, in order to eliminate these accounts receivable and accounts payable, so you will have to pass a journal entry in the consolidated financial to arrive at the consolidated financial position. So what will be the journal entry? So that will be accounts payable will be debited 100 and accounts receivable will be credited 100. So thereby you will eliminate the intercompany transaction so that will not be recorded in the group financial position. So this is how basically you record the intercompany transaction. So when there is intercompany transaction, so we need to eliminate from the group financial position. So it will be recorded in the separate financial statement. However, when it comes to group financial position, so intercompany transaction will be eliminated. Now let's continue the same example. Let's assume his company has settled $50. So they had an outstanding balance of $100, of which his company has settled $50. So as far as his company is concerned, how they will record this particular transaction? So what they will do is they will debit accounts payable by $50 and their bank account they will credit the bank account by $50. So once it is settled, they will record this particular transaction. As a result of that, at the end of the financial period, so what will be the accounts payable? So accounts payable credit $100, accounts payable debit $50. So therefore, the net accounts payable will be credit $50. So at the end of the financial period, they have a balance of $50 due to be paid. It is to be paid to parent company. Okay, so let's assume this $50 amount has not been recorded by parent company. So what is the assumption? We'll assume the parent company has not yet received $50. So therefore, this amount has not been recorded in the books of P. Okay, so they have not recorded this particular transaction. Now, in a situation like this, when it comes to the group financial position, what is the impact? Okay, so this is what we need to identify. Now, when you look at this particular transaction, S company has paid this $50, but this amount has not reached to P. Is that clear? Okay, so therefore they have not recorded this particular transaction. And also, when you compare the accounts receivable balance and accounts payable balance, this in the books of P it is $100. However, in the books of S it is $50, an unequal amount. So these balances are not matching each other. Okay, so when there is a situation like this, if you come across an unequal amount between the accounts receivable and accounts payable, intercompany receivables and payables, so what you need to do is you need to identify the reasons for this mismatching. Okay, so if it is an unequal amount, there will be two adjustments required when it comes to the group financial statement, group financial position. So what are the two entries, two adjustments required? First of all, you identify the difference. So when you identify the difference, you have to record that difference in the group financial statements. So with regard to this particular transaction, there is a cash in transit. So we call it this particular thing as cash in transit. So this is cash in transit. Okay, so this particular cash in transit has to be adjusted in the group financial statement. So how you will adjust this particular transaction? First of all, you need to debit the cash by $50 and accounts receivable has to be credited by $50. So thereby, after recording this particular transaction in the group financial statement, okay, so your accounts receivable, there is a debit balance and credit balance. So that will be, the net accounts receivable balance will be debit 50. Now, when you compare the accounts receivable and accounts payable, the balances are equal. So balances are matching. So now what you need to do is the second adjustment has to be passed. Second adjustment has to be made to eliminate these two particular transactions, these two balances. You need to eliminate these two intercompany receivable and payable balances. So when it comes to group financial statement, financial position, these intercompany balances will not be reflected in the group. Now the balances are equal, so what you need to do is you need to eliminate from accounts receivable will be eliminated, accounts payable also eliminated. So therefore group, there won't be any balances will be recorded in the group financial position. So let's recap what we have discussed in this intercompany transaction. First and foremost, we discussed when there is intercompany transaction, intercompany receivables and balances has to be eliminated from the group financial statement. Okay, so because as far as the group is concerned, group has made neither sale nor purchases. As a result of that, so we need to eliminate intercompany transaction. Okay, so that is the first point. Second point is when you compare the parent and the subsidiary receivable and balances, intercompany balances, it should match, it should equal. So if it is equal, straight away you can eliminate. The second point is when you come across an unequal balances, intercompany balances, you need to find out the differences for these mismatching, differences for these unequal balances. So this may be due to cash in transit or goods in transit. So you need to identify what are the reasons. If the cash in transit or goods in transit exist, what you need to do is you need to make an adjustment to the group financial statement. So how do you make the adjustment? You record this particular transaction, either the cash in transit or goods in transit, you have to debit. So in this particular example, it's cash in transit. So what you can do is you can debit the cash and you have to credit the particular receivable account. So thereby you will match the accounts receivable balance with the accounts payable balance with the other company. So thereby, once you make the adjustment for the cash in transit, so there will be another adjustment that you need to do because you need to eliminate the intercompany receivables and payables. So you eliminate that entry so that the group financial statement will not reflect any intercompany transactions. So this is how you record the intercompany transaction in the group financial statements. So with this I will conclude the session. So I will be discussing intercompany sales with unrealized profit in my next video. And if you like to watch more videos on accounting and management accounting, what you can do is you can hit the subscribe button, and also please share this with your friends so that they will also get benefited. And I'll see you soon with another video. Thanks for watching and bye for now. Hi everyone, welcome to the session. In this session I am going to discuss about elimination of unrealized profit. So this is part of my consolidation accounting discussion. So in this video I'm going to concentrate on elimination of unrealized profit. So what are unrealized profit? How do you account for unrealized profit? What are the necessary entries that you need to pass in order to prepare the group financial statements? So these are the things that I am going to discuss in this session. In this regard, let me take an example to explain the process of unrealized profit. How do you account for unrealized profit? So let's assume P company has acquired its company 80% of shares. Okay, so P is the parent company, S is the subsidiary company. So P had a stock worth $500. Out of $500, $100 worth of goods were sold to S company with a profit margin of 25%. So this is 100 plus 25, 125. So as far as P is concerned, it's a sale. So they have made a sale of $125. So as far as S is concerned, S has purchased $125 worth of goods. Okay, so P has sold $100 worth of goods with a profit margin of 25 to S company for $125. So as far as P is concerned, P has made a sale of 125, S has made a purchase of 125. Okay, so let's assume it's a credit transaction. So therefore, in their balance sheet, there will be an accounts receivable balance of 125 from S company. So S company will have accounts payable balance of 125. Okay, so these are receivables and payables as far as the separate financial statements are concerned. So P has accounts receivable of 125, S has accounts payable of 125. And in the meantime, since they have purchased, S company will have stocks worth 125. Okay, so let's assume by the end of the accounting period, S company has not sold these goods to outside customers. Okay, so therefore, as far as the group is concerned, the stock is lying in the books of S company. Okay, these goods have not been sold outside. These goods have not been sold to outside customers. So therefore, it's lying within the group. So therefore, when you take the group is a separate entity. So group is treated as a separate single entity. So therefore, as far as the group is concerned, the group has made neither sale nor purchases. So we can't say by selling $100 worth of goods to S company, group has made a profit of 25 because it is within the group. So the transaction has taken place inside the group. So therefore, the company has not made any profit. So they will make profit when S company has sold this $125 worth of goods to outside customers. It's something like, I have a pen, I have sold this pen from my right hand to left hand. So as far as myself is concerned, this pen is still belongs to me. Still it's with me. So I have not sold this particular pen to outside person. The moment I sell this to outside person, I made a profit. I made a sale. Okay, so simple as that. Okay, so therefore, when it comes to the group, so you can record only the profit when they make sales to outside customers. Then only you will realize the profit. So as far as the group is concerned, this profit is not realized. That profit is included in these stocks. Okay, so now when you do the consolidation, line by line basis, line by line method, so you need to combine the assets of parent company with the assets of subsidiary company. In the meantime, the liabilities of parent company, with the liabilities of S company. So likewise, when you combine these balances, for example, the stock balance here 400, the 400 has to be added with 125 worth of goods with S company. So when you take this total 400 plus 125, so the total will be 525. So can we take this total amount, the entire amount in the group financial statements? So we can't take this balance because this 525 includes an unrealized profit which is not realized by the group. So that has to be removed from the stocks. So therefore, when you prepare the group financial statements, okay, this 25 has to be removed. This 25 has to be removed and the remaining balance of 500 has to be taken as stock value of group. So what is the double entry? So when you remove the unrealized profit from stocks, stock is a debit balance. So when you take the stock account, so usually it's a debit balance, so 525, okay. So you need to credit this 25. Elimination means we are crediting this stock account. We have to credit the stock account. So by crediting, so you are eliminating the unrealized profit. Then when you credit, where do you debit this $25, the unrealized profit? This is what we have to be very careful. Okay. So to eliminate this unrealized profit, what we did was we credited the stock account. By crediting, we are eliminating the unrealized profit. So when you credit, some other account has to be debited. So what is that account? So that account has to be debited. Now in this case, who has recorded the profit? Who made the sale and who recorded the profit? So it is the parent company who made the sale and they recorded the profit. For example, when you take the sale 125, what is their cost of sales? So cost of sales will be 100. So this is their cost of sales. So when you remove 100, so this will be their profit. This profit will be taken in the equity under retained earnings. This will be under retained earnings $25. Okay, so this will be in parent company retained earnings. So to remove this unrealized profit, what you have to do is, since the profit has been recorded by parent company, this entire 25 unrealized profit has to be adjusted against the retained earnings of the parent company. So how do you make the adjustment? So retained earning is a credit balance. So you need to debit the retained earnings. So you need to debit the retained earnings. So this is the retained earnings. It's 25 they have recorded. So you debit this account and you credit the stock account. Okay, so this is the entry that you need to pass in order to eliminate the unrealized profit from the total stocks. So what is the double entry? Stock account credit and the retained earnings of the parent company who recorded the profit has to be debited. So therefore, when you take the group financial statement, okay, so we remove the unrealized profit from the stock balance and we remove the unrealized profit from the retained earnings of the parent company. So this is how you account for the elimination of unrealized profit. Now let's look at another example where the subsidiary company has sold goods to parent company. So in that instance, the profit will be recorded by the subsidiary company. So in that case, how do you record? How do you eliminate the unrealized profit? So this is what we are going to discuss in the next session. Now let's take the same example where P company has acquired 80% of the shares of S company. Now in this example, S company is going to make a sale to pay P company. So S company is going to make a sale to parent company. So let's assume S company had a stock worth of $500 US. Okay, so they had a stock worth of $500 US, of which they are going to sell 100 worth of goods to P company with a profit margin of 25. Okay, so as far as S is concerned, they made a sale of $125. As far as P company is concerned, they made a purchases of $125. Now, since S has sold goods to P, who has recorded the profit? S company has recorded the profit because the sales value is 125, whereas the cost of sales will be 100. So therefore, the profit is 25. So this profit will be recorded in the books of S under retained earnings. So retained earnings 25. And whereas since P company has purchased this 125, it will be recorded under the stocks of parent company 125. Now, since S company has sold this particular goods to P company, S has recorded a profit of 25. In the meantime, P has purchased this 125. It's lying in the stocks of P company. Let's assume at the end of the period, by the end of the period, the stocks have not been sold by the parent company. Okay, so parent company has not sold this 125,000 worth of goods to outside customers. So as I explained you earlier, as far as the group is concerned, if the stocks are not sold to outside customers, the profit is not realized. It's an unrealized profit. So therefore, that unrealized profit has to be removed from the stocks of the parent company. In this case, because they purchased the goods and it's lying with them with the profit of $25. Okay, so therefore, this unrealized profit has to be removed from the stocks of parent company. Okay, so stocks will be debit balance. So you credit this to eliminate the profit. Eliminate the unrealized profit. So this 125, you credit the stock account to eliminate the unrealized profit. So when you credit, where do you debit? So debit entry has to be made on the subsidiary company, what do you call the retained earnings, because the retained earnings consist of the unrealized profit of 25. Okay, so therefore we need to remove the unrealized profit from 25. But in this case, can we adjust the total amount? Because as far as this subsidiary company is concerned, this profit is owned by two parties. Who are they? This 25 is owned by, 80% is owned by the parent company and 20% is owned by non-controlling interest. So therefore, you need to debit, okay, in the group financial statement, you need to debit the 80% belongs to parent company, retained earnings. 80% of 25 should be adjusted against the parent company retained earnings, and the remaining 20% has to be adjusted in the non-controlling interest. So basically, the double entry will be, retained earnings. Retained earnings should be debited, non-controlling interest also should be debited, and stock value should be credited by 25. So here 20% of 25 will be 5 and this has to be 20. So 80% of 25 will be 20. It should be debited to the retained earnings, and NCI, the non-controlling interest, has to be debited with 5 because this profit is recorded by the subsidiary company. So therefore, this belongs to parent as well as non-controlling interest, NCI. However, in my previous session, I explained you if the profit is if the profit is recognized and recorded by the parent company, then the entire amount of unrealized profit has to be removed from the retained earnings of the parent company because the parent company owns the entire profit. However, here the subsidiary company profit is owned by two parties, which is the parent and NCI. So therefore, we need to allocate this 25 to parent 80% and NCI 25%. So this will be the journal entry that you need to pass when you prepare the group financial statement. So with this, I will conclude the discussion on unrealized profit. I'll see you soon with another video. So if you like to watch more videos on accounting and management accounting, so what you can do is you can hit the subscribe button and please share with your friends so that they will also get benefited.